Welcome to The Explainer. Today we're diving deep into PG&E Corporation's recent financial trajectory. Now, if you follow the utility sector at all, you already know this company has had one of the most complex, heavily scrutinized corporate histories in recent memory. But today, we're stripping away all that outside noise. We're going to look strictly at the numbers, the hard data, and the operational shifts that are defining their reality right now. We're going to map out exactly how this massive holding company, which serves about 16 million Californians, is attempting a pretty spectacular financial and operational turnaround.
Right out of the gate, let's take a look at this incredibly striking number, $733 million. That represents PG&E's second quarter 2026 net income available to common shareholders. So why does this matter? Well, because it represents a massive 41% jump from the exact same quarter in 2025, where that number was sitting at $521 million. This isn't just a slight beat, This is a significant leap driven by higher authorized revenues and really careful cost management, and it sets a very distinct tone for exactly where this company is heading.
Here is our roadmap for today. We're going to cover the Q2 2026 snapshot, core earnings and growth, safety and affordability, the data center catalyst, debt and financial health, and finally, the 2026 company outlook. Let's get right into it.
Okay, Section 1, the Q2 2026 financial snapshot.
Now, when you're evaluating a utility's financial health, you really have to balance shareholder returns with customer realities. You literally can't have one succeeding wildly at the total expense of the other without creating massive regulatory friction. So what's really striking here is that bundled residential electric rates for PG&E's most vulnerable customers are actually down 23% since January 2024. CEO Patty Pope has made stabilizing these customer bills a cornerstone of their strategy. It's a vital piece of context because it proves that their recent financial growth isn't just coming from indiscriminately hiking rates on the people who can least afford.
And this perfectly illustrates the quarterly progress on the shareholder side. Looking at the year-over-year comparison from Q2 2025 to Q2 2026, we see a clear, undeniable increase across the board. Total net income rose from $549 million to $761 million. For diluted GAAP earnings per share, that climbed from 24 cents up to 33 cents, and their non-GAAP core EPS went from 31 cents to 40 cents. The engine is absolutely generating more output.
Moving on to Section 2, core earnings and growth. To truly understand the engine driving this growth and to kind of demystify these earnings numbers, we need to talk about a term you'll see constantly in PG&E's reports, non-GAAP core earnings. This is simply a tool management uses to filter out one-time or really unusual expenses. It allows everyone, both the company and us as analysts, to evaluate the ongoing day-to-day health of the utility without the noise of unique historical events totally distorting the picture. In fact, they even use this metric internally for budgeting and employee compensation.
So the crucial takeaway here is the contrast. PG&E separates these numbers specifically because of their complex history. For example, in Q2 2026 alone, they had $91 million in amortization tied directly to their wildfire fund contribution, plus some investigation remedies and prior period regulatory impacts. By stripping all those non-core items away, we actually get to see how the underlying pipes and wires business is performing today. When we map out those clean core earnings on a timeline, we see a very steady, highly structured climb. They delivered $1.36 per share in 2024, grew that to $1.50 in 2025, and are now projecting a midpoint of $1.65 for the full year of 2026. What we are witnessing is a company systematically rebuilding its earnings power year after year through increased capital investment and really strict operational efficiencies.
All right, Section 3, safety and customer affordability.
Now, earnings are only half the story for any utility. We also need to explore how PG&E is handling its historic risks regarding safety and, critically, how they're funding these initiatives without sending customer rates to the moon. While through rigorous cost reductions, PG&E achieved a cumulative 4-year total of over $700 million in non-fuel operating and maintenance savings by the end of 2025. They even hit a 2.5% reduction in those specific costs in 2025 alone. And they aren't just pocketing this money, they are actively redeploying these savings right back into the business to fund critical safety upgrades.
And here is exactly where those savings are going. They are strictly focused on wildfire mitigation, targeting the completion of over 1,900 miles of undergrounded power lines and over 2,000 miles of strengthened poles and covered lines by the end of 2027. What's honestly most impressive here is that through their simple, affordable model, they're aiming to execute this massive infrastructure overhaul while keeping customer bill inflation capped at just 0 to 3%. It is a really delicate balancing act, maximizing safety while minimizing the financial burden on the public.
Let's pivot to Section 4. This is a big one, the data center catalyst.
So traditional utilities are generally seen as slow, steady growers, right? But the technological landscape is shifting dramatically, and PG&E finds itself right in the geographic center of this evolution. As noted in a recent bar chart analysis of the stock, stronger electricity demand from AI data centers is providing a completely unexpected and massive catalyst. AI models require an absolutely staggering amount of compute power, and that translates directly to unprecedented electricity demand.
Let's put some real numbers to this, because PG&E is not just talking abstractly about AI. They have an expanding data center pipeline of more than 12 gigawatts. Just to put that into perspective for a second, one single gigawatt is roughly enough to power 750,000 homes. They currently have approximately 3.6 gigawatts already in the final engineering stages, with individual projects capped at 1.5 gigawatts just to manage the impact on the system. Make no mistake, this represents a monumental future revenue stream for the company.
Section 5. Debt and financial health.
With all this capital investment required for both safety undergrounding and connecting these massive new AI data centers, we absolutely have to check their financial foundation. Looking at their credit profile as of mid-2026, PG&E maintains really solid ratings. While their overall corporate ratings hover right around that investment-grade border, like S&P's BB+ and Moody's Ba3, their secured debt is comfortably investment-grade across the board, scoring BB+ from S&P and Fitch and Ba1 from Moody's. This is absolutely critical because it dictates their cost of borrowing, and keeping that cost low is essential for funding these massive projects.
On top of that, they have backed up their day-to-day operations with a robust $8.65 billion in total available liquidity. This includes a massive $6.25 billion utility revolving credit facility that stretches all the way out to 2031. Having this deep pool of liquidity ensures they can weather unexpected capital needs, potential regulatory delays, or even catastrophic events without facing a sudden cash crunch.
Finally, Section 6, the 2026 Company Outlook.
So, bringing it all together, what does this mean for the rest of the year? We've seen the historical progress, we've looked at the current catalysts, and based on all the data we've reviewed today, from hundreds of millions in O&M savings to authorized revenue increases and that massive growing AI pipeline, PG&E's management remains highly confident. In their Q2 release, they reaffirmed their solid earnings guidance for the full year of 2026, officially locking in an expectation of $1.64 to $1.66 per share in non-GAAP core earnings.
So I'll leave you with this to ponder. PG&E has engineered a truly remarkable operational stabilization over the last few years. But as they modernize a legacy grid, navigate California's super strict regulations, and scramble to power these massive new AI data centers, is this financial turnaround a finished blueprint, or is this really just page one of a much more explosive growth story? Thank you so much for joining me for this explainer, and as always, keep questioning the data.